Good day, everyone. This is Mayflower M. Lotto, and I am going to present to you the single entry system, accounts from incomplete records. Before I start, let me give you the objectives. First is to understand the concept of single entry system in contrast to double entry system. Second is to identify the records kept under single entry system. Third is to determine net income using single entry method. And lastly, to be able to prepare financial statements based on single entry method. So what is single entry system? It is a system of record keeping in which transactions are not analyzed and recorded in a double entry framework. Thus, records are incomplete and maintained only by bare essentials such as its receipts and disbursements. Also, it is a system used by organizations whose activities are simple, like the non-profit organizations, so they do not need the services of the bookkeeper. But however, they need the services of professional accountants at least once a year to prepare financial report. You might wonder what is the difference between the single entry versus the double entry system. So, here it is. The single entry system has incomplete records of accounts, no account title used, just descriptive measures, and does not employ debit and credit. While in double entry system, it has a complete set of accounts maintained in journals and ledgers. It uses account titles and required analysis of transactions in terms of debit and credit. How does an entity records transactions under single entry system? The transactions are recorded in the daybook, the cash book, and the debtors and creditors ledger. So what are these? The daybook or general journal records transactions not involving cash and recorded in chronological order in narrative format. The cash book, on the other hand, records all transactions affecting the cash receipts and cash disbursements, while the debtors and creditors ledger records transactions that affects the debtors or creditors account. Let's move on to single entry method in determining net income or net loss. So the formula for proprietorship or partnership in determining net income or loss and the using single entry method is this: capital at the end of the year, add withdrawals, then deduct the capital begin at the beginning of the year and the additional investments. Then you will arrive to the net income or loss for the year. Example: an entity had the following data for the current year showing the total assets and the total liabilities with a given amount at the beginning and the end of the year, and the additional investments and withdrawals with the amount only at the end of the year. So, you get the capital first at the end of the year, the total assets minus total liabilities, which is 3 million minus 1,800,000 is equal to 1,200,000. Add the withdrawals, which is 900,000. The total is 2,100,000. Less the capital in January 1, which is obtained from total assets, which is 2 million, minus total liabilities, which is 1,200,000, is equal to 800,000. And the additional investment 600,000. So the total of the two is 1,400,000. 2 million minus 1,400,000 is equal to the net income of 700,000. In case of formula for corporation in determining the net income or the net loss, the formula is the retained earnings at the end of the year, add the dividends declared or paid, and the other items that decrease the retained earnings but not profit or loss, and then deduct the retained earnings at the beginning of the year and the other items that increase the retained earnings but not profit or loss, then the answer would be the net income or net loss for the year. Example, an entity provided the following information. The retained earnings from January 1 is 4,500,000 and the December 31 is 5 million. During the current year, the entity issued share capital with the par value of 2 million and the fair value of 2,500,000 as 10% share dividend. At year end, the entity declared a cash dividend of 3 million. Thus, computation. Retained earnings at December 31 is 4 million, add the share dividends at fair value, which is 2,500,000, and the cash dividend 3 million with a total of 9,500,000 less the retained earnings in January 1 is 4,500,000. So 9,500,000 minus 4,500,000 is equal to 5 million net income for the year. Another formula for computation of profit or loss is the equity at the end of the year less equity in the beginning of the year is equal to the total increase or decrease in equity, add the amount withdrawn, less the additional investment is equal to the profit or loss for the year. Now let's start in the preparation of financial statements based on single entry methods. So, the financial statements that are being prepared first is the preparation of the income statement. So, the income statement involves the computation of individual revenue and expenses balances from cash receipts and disbursements and changes in assets and liabilities. And in order to arrive in the traditional income statement, formulas used in converting cash basis to accrual basis of accounting are useful in this case, and the following must be computed: the sales, the purchases, the income other than sales, and expenses from the single entry records given. So next is the after income statement is the preparation of the financial position, which involves inventorying, counting, and verification procedures to determine the nature and amount of assets and liabilities. And the reference of accounting records under single entry system comes from various sources of information. So these are the possible sources of account balances. Example, in cash, the sources are the cash on hand and the cash records reconciled with bank statements. The accounts payable, the sources are records, documents, and confirmation from creditors, and the equity, which total assets and total liabilities and such. So here is the example in preparation of financial statements such as income statement and the statement of financial position using single entry records and the single entry methods. Negros Store, a proprietorship, provided the following data obtained from a single entry records for the current year. So these are the single entry records from the assets, which are the cash, notes receivable, accounts receivable, merchandise inventory and equipment, and the liabilities, which are the notes payable, accounts payable, accrued interest payable, and unearned rent income with their corresponding balances for December 31 and for the January 1. And the cash book is also given, showing the cash balance at the beginning of the year, which is 600,000, which is equal to the given here in which is cash 600,000, and the ending balance on December 31 890,000, which is also equal here, which is 890,000. Also, the supplementary information are given: sales discounts granted to customers 50,000, sales returns made by customers 150,000, accounts receivable written off as uncollectible 30,000, Purchase discounts on accounts payable paid 40,000. Now, to prepare the traditional income statement, the following preparations or computations are needed to arrive in the needed data for the traditional income statement. First is the computation of sales. So, the note receivable from December 31, which is 600,000, add the accounts receivable for December 31, 1 million, the collections of accounts receivable, 1,500,000, add collections of note receivable, 500,000, sales discount, 50,000, sales returns, 150,000, and accounts written off as bad debts, which is 30,000, with a total of 3,830,000, less the notes receivable at the beginning of the year, which is 200,000, and accounts receivable 800,000. So the total, which is 3,830,000 minus 1 million, is equal to the sales on account, which is 2,830,000, plus the cash sales, which is 400,000, is equal to the total sales of 3,230,000. Next is to compute the purchases. So, the notes payable at December 31, which is 250,000, add the accounts payable, December 31, 500,000, payment of accounts payable, 750,000, payment of notes payable, 650,000, and purchase discounts, 40,000. With a total of 2,190,000 less the notes payable and accounts payable, which is equal to 950,000. So, the purchases on account is equal to 2,190,000 minus 950,000 is equal to 1,240,000. Add the cash purchases, 300,000, is equal to the total purchases of 1,540,000. And then, compute the interest expense. The interest paid, which is 50,000. Add the accrued interest payable, which is 20,000, with the total of 70,000 less the accrued interest payable at January 1, which is 40,000, is equal to the interest expense of 30,000. Next is compute the income other than sales, which is the rent income. First is the rent received, which is 80,000. Add the unearned rent income at the beginning of the year, which is 60,000, is equal to 140,000 less the unearned rent income at the end of the year, which is 20,000. So the total rent income is 120,000. And the other income is the gain on sale, which is the sale price of the equipment, which is 60,000 less the carrying amount of the equipment sold, which is 50,000. So 60,000 minus 50,000 is equal to the gain on sale of equipment, which is 10,000 pesos. So let's also compute for depreciation of the equipment. The amount of equipment at the beginning of the year is 600,000. Add the equipment acquired, which is 200,000, with a total of 800,000, less the equipment at the end of the year, which is 550,000, and the carrying amount of equipment sold, 50,000. So 800,000 minus 600,000 is equal to the total depreciation of 200,000. Since we finish computing for the necessary computations to prepare the traditional income statement, such as the sales, the purchases, the interest expense, the rent income, the gain on sale, and the depreciation, let's now compute the income statement. So the Negros Store income statement at year ended December 31, 2020. The net sales is 3,030,000, which is obtained from Note 1, which is this total sales, which is 3,230,000, which is computed earlier, less the sales discounts 50,000 and the sales returns 150,000. 3,230,000 less 50,000 less 150,000 is equal to the total net sales of 3,030,000 pesos. Next is the cost of goods sold, which is 1,800,000, which is obtained from the merchandise inventory at the beginning of the year, which is 800,000, add the purchases less purchase discount, which is 1,500,000, is equal to the goods available for sale, which is 2,300,000, less the merchandise inventory at the end of the year, which is 500,000. 2,300,000 less 500,000 is equal to 1,800,000 cost of goods sold. So, add the net sales and the cost of goods sold. We will arrive to gross income, which is 3,030,000 plus 1,800,000 is equal to 1,230,000 pesos. Add the other income, which is 130,000, which comes from this. The other income from the rent income, 120,000, add the gain on sale of equipment, 10,000. So, the total other income is 130,000 pesos. So, the gross income, which is 1,230,000, plus the other income, which is 130,000, is equal to the total income of 1,360,000, less the expenses, which expenses is equal to 400,000, add the depreciation, 200,000, the bad debts, 30,000, interest expense, 30,000. The total expenses is 660,000 pesos. So, total income, which is 1,360,000 less 660,000 is equal to the net income of 700,000 pesos. So, next is we can prepare now the statement of financial position at December 31, 2020. So, the assets, first is the current assets, which is cash, 890,000, notes receivable, 600,000, accounts receivable, 1 million, merchandise inventory, 500,000, with a total of 2,990,000, and the non-current asset, which is 550,000. So, the total assets for the year is 3,540,000 pesos. And the liability and equity for the year is first the current liabilities from the notes payable, accounts payable, accrued interest payable, and earned rent income totaled to 790,000 pesos. And the equity from the capital January 1, which is 1,950,000, add the net income, which is 700,000, plus the additional investment 300,000, with a total of 2,950,000 less the withdrawals of 200,000. The total equity is 2,750,000 pesos. So, the total liability and equity is 790,000 plus 2,750,000 is equal to 3,540,000 pesos. So, the total assets is equal to the total liabilities and equity. That would be all, and thank you for listening. God bless.